Welcome back, you legends. I'm Dr. Cal. Let's get right into this weekend market update video. This is the S&P 500 daily chart. Down below in the green and red, up top in the blue and black is the daily chart for Bitcoin. And would you take a look at that? Bitcoin broke out just as we've been anticipating. I've been talking about this short squeeze rally, the FOMO trade, this late stage cycle rotation in an uptrend when the S&P 500 actually begins this topping process that takes several days. Towards the end of the topping process, you see the FOMO trade take on a new life. Here's the breakout in Bitcoin in the middle of May as the market was topping. Here's the breakout in Bitcoin as the S&P 500 was topping in the middle of July. And again, would you look at this? S&P 500 topping in the middle of August, and Bitcoin is breaking out. There's always an ideal position in each cycle of the rally. That includes the bottoming cycle, the bulk of the rally, the middle of the rally, and then the topping process, and then again when we get the pullback and the sell-off. Here is the video discussing this exact type of rotation, vicious FOMO rally coming as the market tops. By the way, I launched a second YouTube channel. Click on this link. It'll take you to my second channel called Money Time Machine Legends. On this channel, I'll cover all the fun stuff. Legends will talk about crazy traders, crazy investors, kind of insane incidents like the one that happens in the 70s when a guy lost it all in a market crash and ended up abducting his banker at gunpoint. Check out that video, kind of crazy footage. Again, I'll be covering fun topics that are related to investing and making money. So I'd highly recommend that you go and check it out. Alrighty, so what happens next? Vicious FOMO rally coming as the market tops. And what happened? Well, we had both. We had the S&P 500 topping, and then we had the breakout in Bitcoin. This kind of late stage fear of missing out, short squeeze toward the end of the rally always happens as the S&P 500 tops. That's because Bitcoin, the FOMO trade, meme stocks, etc., they tend to participate very late in the rally. They don't rally in the beginning or in the middle. Take a look at this. As the S&P 500 was making higher lows and higher highs, Bitcoin was basically flat. Same thing happened between June and July. S&P 500 ripping to the upside, and Bitcoin is actually pulling back. Again, between the April bottom and the May rally, S&P 500 rallying to the upside, and Bitcoin still pulling back. We don't get that squeeze, that short squeeze, that breakout in the FOMO trade until the S&P 500 is in the middle of that topping process. So what happens next? Well, this short squeeze will continue. It is likely to continue into the end of next week, potentially the middle of next week. By the way, I discussed this kind of setup in detail in the trading community. This is what the trading community looks like. I post the trade setups in the trade setup section, and I posted this Tuesday last week. I talked about this in detail. Bitcoin has broken out above the near-term resistance line and above the 20-day moving average. Here's the same Bitcoin chart with the S&P 500 layered down below. Here it is in the blue and black to illustrate this point. Just as the S&P makes that final move higher, tops, and begins to pull back, Bitcoin actually starts to break out. And as you all know, I follow my own advice. That's why I took a trade to take advantage of this kind of late stage rotation. I did take profit in the trade Friday, and I do plan to re-enter that trade. By the way, if you like this kind of content, slap that like button right in the face. If you want to get access to all of my stock market analysis in real time, check out the Money Time Machine Patreon page to get access to the Discord trading community. That's the absolute best way to support the channel if that's something you want to do. Alrighty, so what happens next in terms of the S&P 500? Let's take a look at the daily chart for the S&P 500. I went ahead and highlighted every single time we had a bearish engulfing candle. That means a candle that opens higher than the previous day and then it closes below the opening price of the previous day. This is a classic bearish engulfing candle. We had another one as the market was topping in the middle of July. Then again, another one in the middle of May as the market was topping. and yet again another one in April. In every single example here in the last instances where we had a bearish engulfing candle present itself as the market was stopping, every time we had a small retracement back to the middle of the candle. Sometimes it extends slightly higher and makes a higher high. Sometimes it doesn't, it just stops in the middle of the candle. But it's very common when we get a big bearish engulfing candle for the next 2 to 3 trading sessions to get a retracement back at least to the middle of the candle. We pretty much have done this last Friday, and then one of two things happens. Either we make one, a higher high, or two, we make a lower high like these examples. Retracements fail to produce a new high, retracement fails to produce a new high, and then we move down. The second outcome is we actually make a higher high. If the market makes a higher high, you want to take a look at the NASDAQ. This is going to tell you if the pullback is actually done or if we're going to continue to move to the downside. Why is that the case? Well, I'll show you exactly what I mean by this. We go back further to late 2023, early 2024. We had two bearish engulfing candles. Both of these candles did not confirm to the downside. In this example, in November of 2023, the market actually produced a higher high immediately the second day. When that happens, that usually means this sell-off was rejected. It was a pullback that ended, and the market just keeps moving upside. Then it happened again in December. In this example, the market actually did not make a higher high following day. It went on to make a higher high the second day following the bearish engulfing candle. So how can we differentiate between this example when the market made a higher high the second day and went on to continue the rally, and the example that I just gave you here in July where the market went on to make a higher high but then went back to produce a multi-week sell-off? How can we differentiate between the two? Pretty simple. It is actually fairly simple. Let me show you exactly what to look for. You want to layer the NASDAQ 100 on here. Going to your trading view charts, like on the plus sign, add the triple Qs to the chart. Here's what you want to look for. Here, the NASDAQ made a higher high and actually led the market. Notice how much stronger this move in the NASDAQ was compared to the S&P. When this happens, it's a check mark. The market completed the pullback and we're now moving back to new highs. Again, if I take a look at this example, the NASDAQ again went on to make a higher high. The NASDAQ actually pulled back as the market was moving sideways, and then the NASDAQ went on to make a higher high in the second day following the bearish engulfing candle. Here's the bearish engulfing candle. Here's the second day, formed a higher high. That confirmed that the pullback again was over and we're going to get another move higher. So what to look for now? Well, now you want to look for the NASDAQ 100. If the NASDAQ fails to make a new high, like this example in the middle of July, look at this, failed to make a new high, 3 attempted rallies, failed each time, even though the S&P went on to make a new high. That's a bearish sign. It confirms that the pullback is now just beginning, okay? If, on the other hand, we actually make a new high early next week in the NASDAQ, that will mean this top is done and this pullback is completed and we'll get another move higher toward the end of the month. Now, here's the amazing thing about this FOMO trade rotation. It does not matter whether the S&P actually tops or whether the S&P does not top. It doesn't matter. This breakout nearly always happens. I discussed this in detail in the trading community on exactly what to look for in this kind of breakout, and I'll share with you right now what kind of market structure to look for to know whether this is a fake out or whether this is a real breakout taking place. Take a look at the 4-hour chart. Let me remove all of the indicators that I actually don't need. I don't need the Bollinger Bands. And in the SMA, simple moving average bands, you want to take a look at the 80 period, 80 period moving average on the 4-hour chart. Here's what to look for. Whenever the 80 period moving average on the 4-hour chart begins to move higher, look at this. It bottomed, then it started to curl back up higher. Whenever that happens, you nearly always get a breakout. Look at this again, curling back up, always get a breakout. Look at this, curling back up, always get a breakout. This is true going back several months. Even when the market is just consolidating, look at this, it is curling back up. We got a breakout, another breakout, again, curling back up as Bitcoin is consolidating, and we got a breakout. Okay, so Dr. Cal, I missed the trade. I did not go in. I did not see this. I wasn't aware of this kind of rotation. When do I go in? Well, whenever we do actually get a breakout, we always get another small pullback right around the VWAP of the prior cycle high. This is the VWAP of the prior cycle high in the bright blue. Whenever we trade above it and go towards it, we get a small pullback. That's the last opportunity to get into this breakout in this small pullback. Again, we rally towards this VWAP, the volume weighted average from the previous high. We get a small pullback. And in the next couple of trading sessions, that means Monday or Tuesday, we could potentially extend higher Monday and then come back Tuesday. And that will be the final pullback, the final opportunity to get in this breakout before we actually top and tag this prior resistance line in this multi-month, multi-week bull flag that's been forming in Bitcoin. I hope that makes sense. If you appreciate this kind of detail, please just smack that like button right in the face. And let's keep going because I have a lot of really cool stuff that I want to share with you. So let's jump into the daily charts for the VIX because I discussed exactly what to look for in the VIX as the market was forming this topping process. And as we got that pullback Thursday and that short squeeze Friday, here's what to look for in the VIX to kind of see these market turns before they happen. So the VIX is up top. The VIX is the fear index, the volatility index, whatever you want to call it. This is the S&P 500 down below. And what you want to look for is a classic bearish divergence. What is the classic bearish divergence that I'm talking about? You want to see the S&P 500 inching higher, right? Not ripping to the upside, but inching higher, slightly higher highs. As that's happening, you want to see the VIX forming higher lows. Notice the VIX is actually forming higher lows, even though the market is forming higher highs. Why is this a bearish divergence? Because the S&P 500 and the VIX are inversely correlated. Whenever the VIX is moving down, it means the market is not fearful. It means the market is trending higher. It means pullbacks are likely to be bought. When the market is moving down, the VIX breaks out. Fear rises in the market. That's why you see the VIX breaking out. You see a lot of put buying, hedging against the decline in the market. And so there's a very clear inverse correlation. Whenever one chart is doing one thing, the other is doing the opposite. Whenever the VIX is moving down, the S&P is moving up and vice versa. So what does it mean when they're moving in tandem? That means the S&P is moving higher and the VIX is not moving down. That means fear in the market is actually rising as the market is inching higher. This is a classic bearish divergence. It tells us that big money is rotating into hedging, put positions, and bearish positions. That usually tells us that the market is actually topping. This was true pretty much in every single topping process I've seen. You always get the VIX leading the market. A lot of people talk about technical analysis as a backward-looking tool. This is absolutely false. If we take a look at something like bearish divergences between the S&P and the VIX, these always happen before the move takes place. This bearish divergence always happens before the market sells off. And it's also true we nearly always, get a bullish divergence as the S&P 500 is actually bottoming. And I'll give you a straight example. Look at this. This is the May bottom. S&P 500 made a lower low on May the 31st. And if we take a look at the VIX made an equal high. It did not move higher. This was a bullish divergence because the S&P moved significantly lower. The VIX did not move higher. It told us that the market was bottoming. And you can see these divergences pretty much in every single major market rotation with very few exceptions. So what happens now? Well, now if you are a bear, you want to see the market move higher, and then you want to see the VIX also making a higher low. You want to see something that basically looks like this. Higher high for the S&P and then higher low for the VIX. And if you are a bear, that's a classic bearish divergence, just like the one that formed during the July top. On the other hand, if you are bullish, you want to see the VIX break this low and move lower, and that will indicate the market still has a lot more room to continue to rally. So we just went over what the bearish engulfing candle means on the S&P 500, how to spot a true breakdown like this, right? Look for the NASDAQ 100. Is it making a higher high or not? If it's not, then it's a true breakdown. If it is making a higher high, just like these prior fake out sell-offs, these prior pullbacks that led to significantly higher moves. You want to see the NASDAQ 100 making a higher high. You want to see the NASDAQ 100 making a higher high. We also went into what kind of trade you want to be in. Toward the end stage of the rally, we said the FOMO trade. That means, again, meme stocks, Bitcoin, even stocks like Tesla. Think of the retail favorite trades, right? Cryptocurrency, Tesla, Nvidia. These kind of stocks tend to outperform the market toward the end of the rally. We also talked about what to look for on the VIX. If you want to spot a market top or a market bottom. And now I want to move toward finding a specific upside target. This is Russell 2000. The Russell 2000 realized our upside target for this rally. That was this breakdown level, prior breakdown level. The Russell 2000 was making higher lows, and then once it broke this support line, this now becomes an upside target, and the Russell is basically there. 220 was basically my upside target for the Russell. Can it move? Can it continue to move higher? Yes. But right now, the best place to be is that late cycle rally, FOMO trade in cryptocurrency, in my opinion. The chart you want to look at to find specific market targets, upside targets, is the XLY relative to XLP chart. That is dividing XLY by XLP. And we're still not back at this prior pivot level. Look at this. It held as support, held again, and then broke down. That means this level will attract price action toward it. Whenever we're above it, the market will want to gravitate towards it. Whenever we're below it, the market will want to gravitate towards it. The ratio chart, XLY divided by XLP, has not topped yet. This tells me that stocks, again, like Tesla, like Bitcoin, have not yet topped, even if the S&P has already put in a market top. Now let's talk about the smart money. What is the smart money doing? Up top is the smart money indicator. This is high yield bonds up top. Down below is the S&P 500. High yield bonds are continuing to rip to the upside. They have already exceeded these prior highs. This tells me again that the S&P 500 is still likely to exceed these prior highs. This tells me that this topping process is very likely only for a local top, not the end of this uptrend. Even if the market just continues to move sideways, consolidate, pull back, etc., it is not likely the end of this rally. As we go into early September, the S&P 500 is very likely to exceed this prior high. We're not there yet. Smart money indicating that we will get there in the coming days. Again, another smart money indicator that I use, that is dividing high yield bonds by short-term treasuries. It shows the risk appetite in the market, and risk appetite in the market broke out Friday. This means there's more appetite for deploying more capital in the market, for taking on more risk. This nearly always means we get higher highs in the market. This tells me that the S&P 500 very likely only forming a local top here and will move back to exceed the prior high from July before we actually put in that final seasonal top that takes us down in September and in October for that bearish, that seasonally bearish time of the year. Take a look at market seasonality. In election years, we tend to get a top in late August, early September. That usually is the top for several months, and then we get a couple months of declines in September, October, and then we get a rally right as the election happens. In an open field election year like this year, this tends to be quite a bearish September to January period, right? We tend to get a steeper than usual correction, and then the rally in November and December tends to be weaker. In all election years, however, if we average them all out, we tend to go on to make higher highs in November and in December. It's still early days to figure out whether we're going to follow the open election kind of seasonality or whether we'll just follow the run-of-the-mill seasonality. I mean, Kamala Harris, is that an open field? I mean, technically, she's not Joe Biden. She's not the sitting president that is seeking re-election, but she was part of his government. She's his vice president. So it's really tricky. Are we in scenario number 1 or 2? Maybe it's somewhere in the middle, right? We don't know. It's kind of very tricky this election year. Very, very tricky. Also because we get a rate cut early September that also throws a wrench in seasonality. Okay, so Dr. Cal, when does the final cycle top come in? Not the seasonal top that precedes September and October. No, when does the final top, the last top? Well, just check out the yield curve. If you want to pinpoint the top, simply take a look at the yield curve. When the yield curve exits inversion, when it starts to normalize, that is the 10-2 yield curve, 10-year yield divided by the 2-year yield. Whenever we move below 1 is the yield curve is inverted, that always means we get a recession following that inversion. When that inversion ends, it nearly always coincides with a market top. This is the S&P 500 up top. Down below is the yield curve in this light blue. And I would say this is one of the best timing tools to actually look for that final cycle top, when even as an investor, you would want to look to liquidate most of your positions, rotate defensively, maybe look at gold as the market actually puts in that major cycle top and begins a recession-led crash. We're not there yet. That means we will likely continue to move higher until the yield curve begins to normalize. That tends to happen soon after the Fed begins to cut rates. That means we can expect that to happen in the months following the September rate cut. When exactly, we don't know. We'll just have to keep a very close eye on this yield curve inversion chart. Another key chart that I would say is just as good is the imminent doom indicator. This is my own indicator. I've never seen anybody talk about it. It's TLT divided by S&P 500. That means long-term treasuries relative to the S&P. Whenever we get a monthly breakout and a close above the 10-month moving average in an environment where we have a yield curve inversion, that always coincides with a major market top. Take a look at this. This is the monthly chart. The monthly chart broke and closed above the 10-month moving average. That is this orange moving average. It closed above it. It called the top exactly to the month, that exact same month the market actually topped. That's when we had this huge divergence where bonds massively outperformed the stock market as bonds moved higher and the stock market actually crashed. We came extremely close to doing just that, closing above that 10-month average. I actually covered this as the market was bottoming. I said we did not close above the 10-month moving average. This means we did not trigger the sell signal. That means we are likely to move back to new highs in the S&P 500 as we continue to await for this signal to trigger. That will likely take several months before that happens. So again, take a look at this imminent doom indicator and the yield curve inversion if you're a long-term investor and you're looking to deploy that recession playbook. If you watch this video until the end, I thank you very much and I ask you to slap that like right in the face. And if you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.